Hello, everyone. Welcome to another episode of Intelligent Logistics, a position imaging podcast. I'm your host for today, Daniel Litwin, the voice of B2B. Folks, thank you so much for joining us on another episode of the podcast. We're looking forward to and very excited to be sitting down with both of our guests today, who we'll introduce here in a second, to have some thoughtful discussion, some strategic, actionable analysis. Before we do that, make sure you're heading to our website, position-imaging.com. Again, that's position-imaging.com for not only more information about our solutions and services, but also more position imaging content, including episodes of Intelligent Logistics and other white papers, blogs, videos, you name it. You can also find more episodes of Intelligent Logistics on Apple Podcasts and Spotify. So just hit that subscribe button and you'll find a full catalog of previous conversations as well as notifications when we drop new episodes of the show. All right, team, let's jump in. First, because of the nature of our discussion today, I want to make sure that we clarify and make very clear for our audience, GT Investment Partners LP, who we'll be chatting with here in a little bit, is an investment advisor registered with the United States Securities and Exchange Commission. The opinions expressed herein are discussed for informational purposes only. No representations are made to the accuracy or completeness of any information. None of the opinions discussed herein should be construed to constitute investment advice. This discussion neither intends to nor constitutes an offer to sell any securities to any person, nor is it a solicitation of any person of an offer to purchase securities. Such an offer or solicitation will only be made by a confidential offering memorandum. Past performance does not guarantee future results. All right, now that we've got that out of the way, folks, let's jump into the meat of the conversation today. Today, we're going to be having a discussion on the podcast that's really all about unlocking the secrets to successful fundraising. Again, the secrets to successful fundraising for startups, early stage, and growth stage companies. So we're really painting the full picture here. What I want to do is paint sort of a larger picture of why we're even having this discussion, right? The last almost 2 years, based on some reports, general consensus from pros in the industry, has been marked by a steady decline in some VC funds, or maybe some up and down, to be a little more generous, meaning that hopeful entrepreneurs and startups have had to weigh their funding options with more sobering clarity of mind, right? And they have to ask themselves, can they rely on finding an angel investor, say, to swoop in and support their idea, their vision, or their growth? Will they have to make the difficult decision of taking on major debt from a commercial or institutional financial lender to support their company? They have to ask themselves, how do you even choose the right lender? What makes sense for me strategically, from a clarity and a vision mindset as well, not just from a financial one. How do you attract the right VC eyes, right, and attention when the field is maybe a little drier than it has been in previous years? And does VC or financial institution debt have to be a burden? Obviously, companies don't want to incur a massive debt to equity ratio, but does it always have to be that binary? Well, we're going to be unpacking all of this today. Throughout the episode, we're going to explore the world of, again, funding, debt, equity, and the delicate balance between all of these. We'll uncover the secrets to finding the right investment partners, the pivotal moments that signal readiness for growth, and the critical role of IP in securing funding, as highlighted in Position Imaging's latest success story. So let's go ahead and introduce our guests and get into the actual discussion. I'm pleased to welcome, first up, Mr. Ned Hill, CEO of Position Imaging. Ned, great to have you on. How are you doing today?
I'm good, Daniel. Thanks for having me.
Absolutely, man. And we're also joined today by David Byrne, Managing Director at Ghost Tree Partners. David, great to have you on as well. How are you?
I'm wonderful. Great to be here. Thank you, Daniel.
Absolutely. Real pleasure getting to learn from both of y'all. Let's go ahead and, before we get into some touch points on current events and further discuss strategy, let's give our audience just a little bit of clarity on who they're going to be hearing from today. So, Ned, can you give us the elevator pitch on your background and, sort of your role in this larger discussion? What lens are you bringing to the table today?
Sure. So, I'm a a serial entrepreneur, I guess, but I'm the founder of Position Imaging. Started the company from sort of the embryonic, idea stage all the way through to where we are today, and just through that process have gone through quite a bit of the evolution of the company. But obviously, part of an evolution of a company like this is significantly fundraising. So I've seen the gamut, just being in this industry for 30 years at this stage. All the way through to Position Imaging, have done quite a bit of it. At this point, we've raised just through Position Imaging just under, I think, 80 million in a combination of equity and debt. So we've done a lot of everything, or little of everything, maybe I could say, depending. It's all relative.
Absolutely. So I'm David Byrne, I'm Managing Director and co-head of the investment team at Ghost Tree Partners. Ghost Tree is a $600 million direct lending platform that was founded a little over 2 years ago, almost 2.5 years ago. And we focus on some niche areas in the credit market, which we feel are underserved by the larger direct lenders. We focus on loans that are anywhere between $5 million and $50 million and have a variety of structures. One of the things that we do when underwriting loans and looking at opportunities is we don't look for a set sort of list of criteria. We are flexible around our structures, around looking at the investment itself, what that means, and the margin of safety thereof, rather than look for a very strict profile of if every investment has to look exactly like this. So we're flexible in that regard. As for my background, I have been in credit for my entire career, over 20 years. I have focused primarily on what is known as cash flow lending, or lending levered loans, high yield bonds for companies that generate EBITDA, or what is known as operational cash flow. And my entire career, it's been frustrating to see that there are plenty of companies out there that are creating value, but not necessarily creating it through generation of cash flow. It's intellectual property. The world is no longer really made up of things. It's made up of ideas. And we want to be able to lend to this burgeoning arena of intellectual property, which can be trademark, software, trade secrets. It's not necessarily just patents, but though it does include patents. So we have done a fair amount of work on valuing intellectual property, understanding how to lend to companies that are rich in intellectual property, but short on cash flow. And we've done 5 of these loans so far, and we have a 6th that's coming. So it has been refreshing to be able to work with companies like Position Imaging and kind of understand the value that they bring and the value they have, and being able to lend to those companies to help facilitate growth.
All right, thanks y'all for the context and intros there. Let's give our audience what they came here for, some strategic discussion. So I want to start first by tapping into y'all's pulse on current events. It's always good to sort of get your feel for the market before we start talking really strategically about how to maneuver said market, right? So right now, the VC and angel investor market, generally the, funding market for startups, for growth stage companies, et cetera, has been a little drier than usual, kind of like I mentioned in my intro. At least that's what recent reports from PitchBook show. They have found that venture investment trends have dropped every quarter since Q2 2022. So we're talking, almost 2 years here of a steady decline. However, that may not be always felt in every single market. I know same reports show that Europe as an international market is actually seeing an uptick in, larger VC deals. So there's always nuance to this. It's never that black and white. What are you seeing in the market today, right? Does what you're seeing match up with those PitchBook reports? Give us a pragmatic, realistic analysis here. And then also, where you're holding some optimism, I suppose, for the market.
I mean, David, you probably have a better pulse on this than I do, frankly. So I'll sort of defer to you, but I can say my own personal network. What we've seen is, things have sort of dried up a little bit after the pandemic. I think there's a recalibration, but I don't think it's going to be longstanding. I think things are going to turn, and I think there's a lot of trepidation about a impending recession that. Companies like ours are a little bit immune to that because we actually do well in recession because we provide cost savings technologies and solutions. But in general, I think that is part of the reason there might have been a drier last couple of years. But David, you might have a different take on that.
No, I would agree with that wholeheartedly, Ned. I think it has been tougher in terms of raising capital. I think any sort of CEO of a startup would tell you that it's much tougher today than it has been for a while. I think there's been a little bit of a retreat and focus on what you have in the portfolio from a venture capital and venture lending point of view. Not to belittle the struggles that entrepreneurs put up with in needing to raise capital to get to the next place, but this kind of pause in a funding environment can be healthy, right? Companies start to focus on generating cash flow, not growing at all costs. They work on sustainable business models, not necessarily just growing the top line and growing the negative bottom line as well. It's, what can you do with what you have? How long can you last? And let's see clear, not to just the next round of fundraising. Let's go to be profitable. Let's go to a place where we can have a sustainable cost structure that fits with our revenue base. And I think that part of it is healthy. Again, I don't want to belittle the difficult parts of it and the companies that might not make it. But I think that there will be a sort of healthy reset coming out of this, of capital is going to start to flow to companies that are focused on profitability, not just gaudy revenue growth.
So then with that as context, both of you obviously have extensive experience in the world of funding, entrepreneurship. We're getting both sides of the spectrum here. And so with that, what are some indicators that you recommend folks to look out for when weighing the decision to evolve from bootstrapping a venture to funding it? Right? Especially in the context of today's market, today's availability of funding. Give us your thoughts.
Well, David, I'll take this one to start. So sometimes you don't have a choice, right? I mean, if you're funding and you're at a certain level, you're not going to go to a venture debt group or somebody like a Ghost Tree without a heck of a lot of IP or some good cash flow down the road, or et cetera. So some of this is just out of your control. I mean, bootstrapping is great, but it's great up to a point. Eventually, you're going to need some money, and at that point, you're going to either need a solid plan and contracts to show cash flow, or ideally, you're going to have at least some patents in your portfolio if you can protect it that way, because you're going to need something to get into the venture realm. Whether it's we talk a lot about venture capital. Even if you go to the angels, angel investors are not dumb. They're not going to just throw you money because you're a nice person. You're going to need a story, and the story cannot be a bunch of fluff. It needs to be, protected. It needs to show a clear path to profitability. It might not be direct path, but it's got to be a clear path to profitability and, some good markets. So, some of this stuff is just dictated by the stage. But again, a lot of this is really once you get to the growth stage, like we were at and we're at now, it's how do you want to ignite that growth, right? And so you've got a couple options at that point, but in the beginning, you don't have many. At least that's my humble opinion. David, I don't know if we do what you think, but.
No, I think that's right. To sort of approach the financing community at this point, you do need to be farther along in your business plan. And it can't be we have a great idea and it's a huge market, so let me have some money. It needs to be, we're really close to commercializing, or we are commercializing. We need this to grow. This is exactly what we're going to spend it on. It's not going to be spent on increasing massive amounts of overhead. It's going to be used on revenue generation, which will get us to profitability in X number of months. I think we need to be a lot more specific around the business plan now than in previous times.
Well, Ned, let me toss a question directly your way here. As a founder and someone who is a self-described serial entrepreneur, has managed the creation of multiple companies and had to deal with the ups and downs that naturally brings, the difficulties of teamwork that naturally brings. As a founder, what qualities or attributes do you believe are essential in an investing partner? We'll get your side of this first, and then we'll get David's side.
As an investor coming in, you mean?
Or as a founder, what do you think is essential from the investing partner? So an investor coming in, funding your operation, what attributes or qualities do you think are essential in that partner?
Well, I mean, I think, open lines of communication. I think a knowledgeable investor is the best kind of investor, somebody that can actually give you some value add when they invest. I think one of the worst investors you could ever bring on would be somebody that doesn't understand your business or what you're trying to do, because then you've got no support. They're not going to know, what the big picture is. They won't have the patience that it might require. So for me, you need deep pockets, right? You need to know that there might be more money there if you need to go back, which you'll always need to go back. But really, it's a knowledgeable, supportive investor in my humble opinion, because if you get somebody in that just thinks it's fun to put money in a startup, it's just not going to work. They're not going to be realistic. They don't know. They're not going to know the trials and tribulations of a startup or a venture firm. And in general, I don't think those kind of relationships will work. So when I brought on all of our investors, we have a lot of privates, and Ghost Tree, all of them had the qualifications for the most part of really understanding the business, because not only will they understand what we're trying to do, but then they can probably help you on the path, because if they know that you're going in this direction and they know another associate or colleague or another investment is going in the same direction, those can probably be synergistic. And so it really helps on multiple fronts if they know what you're getting into, they're knowledgeable, and then they can give you some solid feedback along the way.
All right, we'll flip it now. David, from the investor's perspective, you're handling the funds, you're deciding where to deploy them, where you're going to see the biggest returns, and trying to align some vision with, those serial entrepreneurs. What characteristics do you look for in entrepreneurs when you're considering an investment? And are there any specific examples you can share where you found that these qualities really played a significant role in guiding your decision-making?
Sure. So in terms of what we look for entrepreneurs, obviously we have to have someone who is honest, who is forthright with all parties, who can manage up and manage down, who is a leader, and the people at the firm respect this person, and is also self-aware enough to know that he or she cannot wear every single hat. It is really difficult to do everything well. Usually you do a few things well, and it's the best leaders are the ones who know how to delegate and know how to move off responsibilities and sort of understand that I'm really good at doing this thing. I will continue to do this thing and rely on the expertise of others to advance other areas of the company. It is challenging at times, no matter how good someone is, if they try to do everything, something falls out of focus. And that's when bad things start to happen. Again, in sort of previous experience. But having someone who is honest, forthright, and communicates well, as Ned said, those open lines of communication are crucial, right? There are things that are small problems that turn into big problems, and nobody likes hearing about the big problems when they are big problems. You want to hear about it when it's a small problem and you can deal with it, you can course correct a little bit, you can change here and there, and we are a lender, we're not entrepreneurs. So there are things that are important to people like Ned that aren't necessarily important to us or that we don't know about yet. So we need to have that sort of open communication. And if there is a little bit of a cult-like aspect to this person, that they are this sort of deity on high, they might talk a good game with you and be honest and say they're willing to take some coaching, they're willing to take some advice, but in reality, they probably will be less likely to do so. So, we have found kind of throughout our careers that pay attention to the people who lead by example, are willing to delegate, have strong teams around them, and know how to build strong teams. There are times when I have worked with entrepreneurs that seem a little quiet, not necessarily overly, loud and proclaiming the excellence of their company, but man, the people around them are universally good. And you start to say at some point, he or she must actually be really good at building teams, because even if they're not the best rah-rah cheerleader, they're incredible at finding the right people to bring around them and to motivate those people and to keep those people engaged, which is something that it's very difficult to glean from a few in-person meetings or a few phone calls. But you really understand if they've been working with this person for a few years, clearly they have something that's of quality. So having all of that and having the sort of pragmatic sense of, as a lender, at times when we come in, this is the first time the company has had debt. So, we need to explain what is important of maintaining liquidity, understanding interest payments, and all those things that seem relatively small, but when your focus is just running a company and growing that company, you don't really think about those things. So having someone who is willing to focus on those, refocus, reorient a little bit, and be able to understand the realities of dealing with debt versus just equity funding is of crucial importance. And I will say, in past investments, I think the real learning has been, there can be people that, again, are just so dynamic, so intelligent, and really make you believe in the story, and that's great. But if the next layer down doesn't have that depth and isn't, they don't necessarily need to be the same kind of cheerleader, but you need that depth, that sort of ability to run parts of the company separately. Otherwise, the whole thing falls apart. Even if that person is the best leader in the world, they still cannot run a whole company and fundraise and sell and do everything else they need to do.
Okay, so you're both obviously highlighting here a necessity for honesty, for leaving the ego at the door. I mean, a little healthy ego is obviously good for any entrepreneur, right? But the ego that's going to get in the way of clear decision-making and open collaboration needs to be left behind. But what really stood out in both of y'all's answers here is this idea of active collaboration, delegation, and having leadership that's willing to work together.